losing a little bit of our momentum as the Russell pulls back from 21 slightly. 10 minutes until we finish things up. We'll keep our eye on the market, but let's also talk about the big picture with our team from Schwab. Cooper Howard is Director and Fixed Income Strategist, and Michelle Gibley is the Director of International Research at Charles Schwab. Good afternoon, guys. Cooper, let's talk about this bond move here. We've got a little bull steepening at the top of our show. Father of yield curve analysis, Campbell Harvey, told us that's the bad one. What do you think? Do you agree?
You know, I wouldn't necessarily say I agree or disagree with it. I think that what we saw from the Fed was a little bit of a mixed message. I think it was notable that they revised their growth outlook a little bit higher while pulling in the inflation expectations, moved those up a little bit. So I think what you saw and what you heard from Chairman Powell is that he is comfortable with stronger growth going forward. And we know the direction of interest rates, the direction of policy is going to be lower. However, we don't know when we're going to get there. And what I think that I heard today is that it's going to be a bumpy road to get there.
Yeah, the combination of better growth outlook, same number of cuts, I think is what's making us scratch our head a little bit here, Michelle.
Well, I mean, if I compare it to the rest of the world,
yeah, is that standard?
I would say that the rest of the world is still on track for rate cuts this year as well. Overnight we had inflation figures in the UK, a little bit hotter month over month, but slower year over year. And it means tomorrow the Bank of England is probably not going to do anything. They need more time before starting to cut rates, probably lag the ECB and the Fed in timing. The UK economy is really weak. It's flatlined for 3 quarters. Unemployment is up from 3.5 to 3.9%. And so there's some disagreement on the MPC on what to do next. In fact, it's been 2.5 years since the last unanimous vote. And in fact, at the last meeting, the Bank of England had 1 member voting for a rate cut immediately and 2 members voting for hikes. So lower inflation today may mean the voting tally changes tomorrow. It might be the only thing that changes. We might get 1 fewer member voting for a hike. Markets believe it's a better chance of an August cut than June, though.
Okay. Maybe a fun hypothetical here. If we had the same economic data as England, Cooper, would we be cutting faster too? I mean, do you think that Powell is expressing any concern about the data? Is he implying any concern about the data by being fairly nonchalant about the inflation data moving against him recently?
Yeah, I think that's a very good question. One of the things that I really took away that stood out to me in the press conference was that he kind of let the market know that we already have next month's PCE report. So he said that it's 30 bips lower. So I think that to me kind of says that the Fed is comfortable with the direction of inflation. And that's one of the reasons why they are continuing to hold interest rates at where they're at right now. So I think that that was a little nugget that he sprinkled in there. So again, we know the direction of rates and what they're wanting to do is that they are wanting to cut. If we look at that 2024 median, yes, it was unchanged, but the number of dots surrounding that median really just tightened down. So yes, they are projecting 3 rate cuts this year. That was next year in 2025. That was revised a little bit from 100 basis points of cuts to 75 basis points of cuts. So maybe we don't get as many rate cuts, but projecting what's going to occur between now and 2025 is very difficult, given that the number of the inflation readings, the number of economic readings, employment readings that we're going to get between now and then, potential surprises. So I did think that little nugget that he sprinkled in about the PCE number was pretty important, though.
Okay, and then to come back to your point about the dots, the clusterings got tighter, right? Our spread tightened in a little bit. So I guess if we're like super technical, and if we take cuts out to the 10th of a percent, then technically it did, I guess, get a little bit hawkish if we technically, right?
Yeah, I guess technically. I mean, even if you look at that median dot on the long run, that moved up by 0.06. So
yeah,
we're rounding that up now. We're rounding that up in the market to increase it by 0.1.
Okay,
but I thought that what was interesting about the long-term dot is the number of Fed officials that are above that median. So I thought that that was the change, not necessarily the median itself moving slightly higher, because that's more of a rounding issue that's coming into play.
Yeah, all right. I'm kind of liking the dots. I miss the dots. It's fun looking at the dots. Michelle, all right, so the fact that we're getting the dollar hit, maybe yesterday's Bank of Japan move suddenly does look bold on the global stage.
I don't know if I'd call a 10 basis point hike bold, but it is certainly it's a different direction than the rest of the world. And the Bank of Japan is hoping for higher wages and hoping for higher inflation. So we got a little bit higher wage demands last week, and that enabled the Bank of Japan to hike rates for the first time in 17 years. That is historic. But 10 basis points at a time is small relative to 25 the rest of the world. There might be one more hike this year from the Bank of Japan. As you mentioned, the yen was weaker yesterday despite the hike, and that's just because it was well telegraphed, and Governor Ueda was very dovish in tempering, against the idea of a series of rate hikes. Japanese stocks, though, are still the best performing market globally, and that's due to attractive valuations, some corporate reform, and those economic changes, which are boosting earnings.
All right. Like the perspective, keep us grounded and balanced, thinking about the rest of the world. All right, Cooper, the last quick thought is when we look at data, should we expect less volatility in bonds around it in the short term if the Fed didn't respond to the data the last 2 months?
Unfortunately, I don't think that we should expect less volatility going forward.
Okay.
What we also heard from the Fed is that they are very data dependent. So that means that we as market participants and analysts are going to highly scrutinize each data release that's going to come out, probably putting more weight on the inflation data than a lot of other reports. So I do expect that this volatility is here to stay as we kind of try to navigate between what's happening now and what the Fed's potentially going to do.
Okay. Great stuff. Thank you very much, guys. Fun conversation. Michelle Gibley and Cooper Howard. Good look here at what we learned today from the Fed.